ask me, people get overwhelmed due to a couple of reasons. One, I don't know how to start. If money is the problem, you don't have to worry about it. As low as 500 rupees, you can still start investing. Where should you invest? People interchange or confuse the words investment and savings. Principles like stay in the market, buy low. But to an initial investor, this is my advice, I would actually say. COVID was a thing where I know of a lot of clients who absolutely were hell bent that they want to take all their money. Gambling is not something which you accidentally get into. Don't do day trading, don't do F&O trading, then it's not gambling.
Hello, viewers. Welcome to Shree Consultant's first podcast. In this podcast, we hope to cover certain areas of finance and investment, such as how to begin your financial journey, how to manage your wealth, and how to grow your wealth over a longer period of time. Today, with us, we have Mr. Biju Mohan, who has more than 2 decades of experience in the field of finance and investment. He's worked formerly as a vice president at Royal Bank of Scotland. Right now, he's the principal consultant for sales in Shree Consultants. Welcome, Mr. Biju Mohan. It's a pleasure having you on our podcast.
Thanks for the introduction. Pleasure. Excited to be here.
Today, we've structured our podcast in such a way that we can offer something insightful to our guest, while also making sure that we don't overwhelm them with jargons and things of that nature.
Thank you. I appreciate that.
And I hope we can get into it. So, the first question that anyone might have pertaining to finance or investment is: there's so much of knowledge out there, and especially if you're a layman who's just getting into this, there's so much you might not know, and it's easy to get overwhelmed. So how can someone begin investing without actually getting overwhelmed by the amount of information and things that are out there?
It's a good question. Yes, it's a very, very common, thing we hear in the advisory field. See, if you were to ask me, people get overwhelmed due to a couple of reasons. One, I don't know how to start. Second, do I need a lot of money? Third, probably am I, I have money. I know where to, what to do, but which funds or what stocks do I invest in? So these are the kind of things. So if you ask me if you are not aware of, whether if money is the problem, okay, you don't have to worry about it. As low as 500 rupees, you can still start investing. So that's not too much of a problem. Where should you invest, right? Ideally, I would say you can go two ways about it. One, you hire somebody to help you out with that, because at least in the beginning stages, till you get a grip of your own finances, it's better that you go through an advisor. Makes a lot more sense because they'll be able to guide you rather than you investing for the first time in something wrong. And God forbid, were you to have a bad experience, it'll put you off from that experience for life. It'll give you that, trauma sort of thing. So I think that's a better way. Or else, if you're really interested in a do-it-yourself kind of a thing, there are millions of courses on YouTube available. There are paid courses which are available, which you can take up, study about it, learn about it, and start with a small amount, again with a 500 rupees kind of a thing. Ideally, what I would say is, like how if there was a specialized job, we wouldn't do it ourselves at home. Exactly like that, investments is not something which you just do as a trial and error. Could be dangerous. So makes a lot more sense to get an advisor. And in today's date, you can even consult. You don't need to get a registered investment advisor. You can go to an MFD and they can help you out with which are the best funds running.
Yeah, I think it's very useful and it's very valid. And when it comes to building wealth, what are some useful money management principles that our viewers can apply, even if they're not starting out with a big amount?
I think one of the most basic principles, and that's a lot more prevalent in India as such, is people interchange or confuse the words investment and savings. Indians have a very, how would you call it? They're so used to seeing their previous generation, a parent or a grandparent, saving in, savings instruments like FDs and gold, that the only sort of investments that they understand is real estate, right? They don't see anything else as So that's one issue which we have. The second thing is people also mistake the timelines which you would require for an investment versus a savings. So if I was to just clarify in a how do you say, as simply as I can, savings are something which you keep aside for a emergency and you don't expect any returns out of it. That's savings, right? Investments is something which you won't touch in case of emergency and you expect a lot of return out of it. Now you if you mix these two, that's where the problem comes in. If you are looking at uh, you're looking at an investment with all the money that you have. So in an emergency, you have to withdraw out of that investment. And the investments by its nature can be volatile, right? So that's what we advise clients normally is, and this could vary for people. The younger you are, the lesser the time that you require as a emergency cash, this thing. Ideally, 6 months, right? If you have 6 months of expenses covered as um, if you put that aside as savings, anything over and above that, you should invest for the long term so that, even if there is an emergency, you have something put aside. You won't touch your investments in case something comes up like that. So ideally, if you ask me, that's the way I can say that's the most core principle of investment. It takes away a lot of things, which is, I can't take risk. I don't know how much it'll go down. It gives me stress. If you have something for emergency, why are you stressed? Because when I need it, will I have my money, right? But you also, on the other side, you are stressed that will I earn enough? Dividing your pile of cash into these two, these two, how do you say, if two purposes, makes a lot of sense. And I think that's one of the most core principles that anybody should take. Apart from that, you can give a lot of oft, talked about principles like stay in the market, buy low. But to an initial investor, this is my advice. I would actually say separate your savings from your investments. They are two different things.
Separate your savings from your investments.
Absolutely.
That makes a lot of sense. And what are some of the steps that we can take in terms of um building our own financial mindset in such a way that we can budget and plan for our future investments so that we're clear in our head as to what we want out of our financial goals?
See, I don't know if Warren Buffett said this, but I read this quote, which is something which at least guided me when I was younger, right? It says, invest, okay? Set aside money for investments, and whatever is left, spend that, okay? Normal practice which we have is we spend whatever money we have, and whatever is left, we'll try and invest or save that, right? So if you ask me budgeting wise, investments, like how you would plan that, groceries this much, my internet bill this much, my phone bill this much, you should have investments as part of your budgeting right in the beginning, and you spend the money which is left after that, rather than you spend all that you can, and whatever is left in my account at the end of the day, I'll try and put it into something. So that's, I call that the good EMI. You start an SIP, and somehow or the other, you don't want something to bounce out of your account. So it's a forced saving, which is a good habit, rather than paying. It's much better than a loan EMI, because this is money which you're saving for yourself. And God forbid, was there to be an eventuality, you can always pick out that money. Budgeting is more of a mindset thing, I think, rather than budgeting for investments, by the way, is a mindset thing rather than, how would you call it, rather than doing something, which is tactical. The best way to do this is, one, have the mindset that you need to invest. There has to be some money to what you are today has to take care of your future self. You are at this point of time taking care of, think of it like a like another parent, right? The older you is another parent you're going to take care of right now, to so that when you get into that role, you take care. So if you have that mindset, so you will start taking care of that corpus. If your mindset is coming, and right from the younger age, if you just think that, yeah, you only live once, and if you start spending, sooner or later time catches up with you, and by the time you're 30, you will definitely be regretful that you didn't start earlier.
Yeah. So, your essential advice is to look at budgeting and savings as a whole as a part of your essential, just like how you would look at
Absolutely.
some of your other monthly.
Spend what's left after your investing for the month is done,
Okay.
rather than spend and whatever is left, you invest that.
So it's a clear invest first and spend
Budget
next.
for your investment.
Yeah, yeah,
Yeah.
yeah. I think that's useful. But usually, people with limited knowledge or perhaps even no knowledge, when they get into financial investment and things of that nature, even the healthiest investment to them feels like a risk because the fear of losing their money is always at the back of their mind. So, how can someone get used to this idea of accepting risk or accepting the fact that risk is a part of your financial investment without feeling like they're gambling with their money?
There are a couple of points to answer in that question. The earlier point we talked about, that uh, separating your savings from your investments straight away takes care, and I was mentioning it that at that time. It straight away takes off this stress which you have, that what if my money goes down, because you don't need it for an emergency. You can afford to wait even if it goes down. And in the market, usually it's a question of when, not if. If you stay long enough in the equity market, you sooner or later make money, right? The question is, when will I make money? And that's where nobody can give you that kind of an answer. So that's typically where it comes from. So one part of it is, in the short term, if you don't want to worry, have a savings pile before you even start investing. So put out, put a small savings corpus for you, which is in a savings account, in an arbitrage fund, or on a in a liquid fund, anywhere where you feel comfortable, because it doesn't matter what you earn with it. Savings is not for earning, it's for safekeeping. Protection is the key, right? After that, start investing so that you don't get tensed at every fall. You have the courage and the ability, or the bank balances, to wait it out, right? So that's one thing. Second thing, you talked about gambling. Gambling is not something which you accidentally get into. Don't do day trading, don't do F&O trading, then it's not gambling. If you're investing where you are understanding an investment before getting into it, or you're taking the help of somebody who's an expert and then investing, then it's not gambling. You're taking a calculated risk. And that's the whole point. And when you take a calculated risk, you don't take all your money and sell all your gold and put everything into. Now, that's a gamble, right? So, gambling is day trading. Gambling is, to an extent, I would say, I don't know, we might get backlash for that, but there are able traders, but 99.9% of the people I know don't trade because of technical knowledge, or because of, they read charts. They just do it because somebody's told them, or some, brokerage has told them. And more often than not, brokerages earn both ways, when you buy, when you sell, right? So there is a lot of encouragement which comes for trading. I don't think you genuinely end up making money in the long term by trading as much as you would with investing.
So I think some of the main points that you've covered is, before you start your investment journey, have a sustainable amount of corpus in your savings account so that you can wait out your investment period. And another important point that you had mentioned was, don't fall for anything that guarantees you quick money, or seems too much of seems too good to be true, if that makes sense. And you also have a lot of that in today's day and age of social media, where almost in every nook and cranny, you can find someone that's selling a financial course that sort of guarantees a significant return if you were to apply the methods that were taught over there.
That's
So, what I want to ask you is, what are some of the standard good, quote unquote, good advices that people can give you or people give you, which have to be applied or which can be applied? And what are some of the usual bad ones that you get? So, can you give me some examples of common good advices and common bad advices so that it helps our viewers when they probably listen to the same from their family members or friends that recommend them to invest?
it's good advice has become cliched in the market. That's how many times, people have given good advice out. Invest only if you've understood a little bit about the concept, or if you have an expert advisor whom you can trust. Otherwise, don't come into the market. It just doesn't make sense. A good advisor can get you into good mutual funds, or probably, if there's a stock expert, can get you into stocks too. But if you are doing it by yourself, if you're a DIY kind of a investor, know your subject. Just don't watch three influencers giving you advice and then think you know all there is to be known. So that's my advice to people, because again, I'm not trying to trivialize the audience or thinking less of them, but there is quite a lot. Even SEBI has come down on influencers quite a lot in the recent past, because there is a lot of kind of a cult following, which people have started thinking that it's easy money what they say. Again, I don't want to come and paint everybody with the same this thing, but be very careful where you get your advice from. Do you trust them? Do you hold them accountable? Is there some track record of the advisor that you have? So that's something which you should do a little bit of due diligence before you start listening to somebody. Or else, if you're a DIY kind of a person, study this. Even decide not to invest for the next 1 year and just study. See what is happening. Think of a imaginary corpus. Had you invested in something, how would that go? What is the principles? So that's something which I would say, know what you're doing is something we've talked about. Couple of points which are commonsensical, which we've discussed before. In the long run, no matter how much you try to time the market, I have in my career seen people who make the most amount of money are the ones who've actually forgotten that they've put in some money into the market. People who track their funds on a day to day basis usually end up making less money, not because they've invested in the wrong asset class, not because equity is risky and you when you see it, it becomes risky. Usually it's because of the fact that they are not able to get a grip on their own emotions. So a market is falling down for 3-4 days and suddenly it starts making you panic. We've had recent instances. COVID was a thing where I know of a lot of clients who absolutely were hell bent that they want to take all their money. And it was just, it was the same sentence which we had talked to we've told so many customers that this day next year, you're going to regret this. And people who listen to us, you know, laughed all the way to the bank. But otherwise, there was a lot of regret too, because people caught the market. Now, what happens is when you stay out of the market when there's a fall in a COVID kind of a situation, it goes up so fast. And then you start thinking maybe it's gone up too much, it'll fall again. Yeah. What happens is you again keep seeing. So it's more grueling emotionally than seeing a money fall down. So there's a lot of emotion. Investing is more behavioral or emotional control than actually finding the best investments.
And speaking of regret and speaking of missed opportunities, let's say there's someone who's missed a massive financial opportunity where they could have bought at a dip, where they could have made a lot of money. What would you tell that person in order to sort of revive his spirit to get back into investment without feeling like, all possibilities of making good returns are out of the window?
There's a lot of, how would you say, missed opportunities are basically hindsight. It's only when any opportunity is over, only then do you understand it's missed. Yeah. That doesn't mean there are no more opportunities coming up. Yeah. Okay, I don't have charts in front of me right now, but let's talk about that COVID incident, which I was just talking about previously. In March, okay, if everybody had on March 23rd, 24th, that was I think the shortest tip. If somebody chose not to invest, okay, they decided that no, the market is going to fall a lot more, I'm not going to, and they thought they'll wait for another month before this thing. It, if I'm not wrong, by November, the market had gained all, November 2020, market had gained all that it had lost within that time. Now think of this same guy sitting in November and he thought, oh my God, the dip is anyway over. I think now the market is overheated. Had he not invested even on that day when the market had, the dip was almost eaten up, he would have lost out on 40% of the returns in the next 1 year. So just because you think the market is, back, you've missed out an opportunity, doesn't mean there's no opportunities lurking ahead. And if somebody at that point of time had remained, they would have probably made about 200% return by now, even if they missed the whole dip. Okay. Another thing which you need to understand is missed opportunities are when you are trying to time the market. A great strategy for getting in or even out of the market is through a systematic way. There are systematic entry plans which where you have your STPs and your SIPs. There are systematical exit plans, which is like your SWP, right? They always average things out because none of us hires a a soothsayer or a jyotish to invest.
Yeah.
You can only make economic predictions.
Yeah.
You can't make which day what happens. There's also an emotional aspect. We are all humans, we're not machines. It
Yeah.
doesn't work that way, which is why it makes a lot of sense to automate the way you get in, right? So if you have money right now, unless and until you really think the market's fallen down some 25-30% where you put lump sum, if you think it's the regular market, enter the market in a systematic sort of a manner. Sooner or later, you'll realize that you've averaged out, may not be the best returns, but you would have got the most optimal returns for that time of
Yeah.
entry that
Yeah.
you had. Even withdrawal, I would say that if there's a goal coming, don't wait for the last day or the last month to withdraw.
Yeah.
Start withdrawing 6 months, 12 months before,
Yeah.
because you never know right at that point where you need the money, what could happen at that point in time.
So, like you said, we're prone to making errors during short-term market volatilities. So, during such moments, how can someone retain a longer-term perspective when it comes to making their investment decisions?
I'm going to come across like a stuck record on this because I've talked about this multiple times before in previous questions you asked. But the very fact that you have a separate bucket for investments and savings will itself give you that comfort that when there is term, short term volatility, which is normally what we get. By short term, I mean which is anything under 1 year, right? When there's a short term volatility, 3 months, 6 months, 9 months. I don't see usual phases where there is a bear market scenario for multiple years, at least not on a regular basis. There are, but not, it just doesn't keep occurring. I think the very fact that you have something tucked away as savings where you can dip into in case of an emergency gives you that comfort that I don't need to reach out into this. And the very fact that you understand how compounding works and the understanding that timing, even the best investors in the world, in the history of the world, have not been able to regularly time the markets. They'd be lying if they say they time the markets. They might have had one instance, two instances right where they probably got the timing right, but on a it's more a lucky call rather than where you take a very calculated guess which day is going to be the lowest in the market. So I personally think let the investment run its course is something which we should have as a mantra in us when we are entering the markets. And for that, it's very important that you have some amount of emergency cash, which will keep you calm when the market is up and down. Usually, in a year max, or maybe at the most, multi year bear markets, maybe a year, 2 years, you should start seeing and the market makes up for the longer the time that it's been in a bear market, the faster you'll see it make up that it has to. It's like a spring.
Yeah.
So I personally think one single thing that will go a long way is have a savings bucket and invest after you built your savings bucket.
I'm really glad that you've shared such insightful information with us today. And I definitely hope and also feel that our viewers have definitely taken home some of the key points that you've mentioned today. And I hope it's been of use for them. And I hope we can have more such conversations in the future.
Forward.
Definitely would
Look
love to
forward.
pick your brain. And once again, thanks for
Pleasure.
being with
Pleasure.
us.
Pleasure.
Thank you.